Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 4th of March. I'm Daniel Lam, your host for the podcast. There is an emerging narrative that there is stagflation risk in the US economy, i.e. growth slowing while inflation remains sticky. Factors such as the impact from DeepSeek and tariffs, which raise consumer prices and hurt growth, contribute to the nervousness in the markets. The increasing pessimism from consumers is an important differentiating factor versus the few growth slowdown episodes since 2022, because consumption is the main growth pillar in the fourth quarter GDP. It is at risk because financial conditions remain restrictive and the saving rate is near historical lows. The post-COVID labor market was the strongest since the late 1960s, which, along with loose fiscal policy, underpinned an extremely strong recovery from the COVID lows. While animal spirits were seemingly unleashed by President Trump's election, policy uncertainties had started to creep into the data. So according to the Conference Board's Consumer Confidence Report, the share of consumers expecting fewer jobs 6 months from now has surged to the highest level since COVID. So this has led to US 10-year government bond yield retreating from close to 4.8% to the current range around 4.2 to 4.3 towards our own forecast range of 4 to 4.25 over 6 to 12 months. Markets are now expecting 2 to 3 Fed rate cuts by the end of the year, largely in line with our own expectations. So what do we expect from here? Well, the concerns about stagflation is likely to lead to a little bit more downside for US 10-year government bond yield. However, the recently US earnings season has shown that US companies are still fundamentally sound. Hence, we expect further tightening in credit spreads. DMIG yields are still attractive relative to historical lows from an income point of view. We also favor DM high yield and remains overweight there because default risk remains contained in the current state of the economy. For US dollar bonds, we believe a 5 to 7 year average maturity profile offers an attractive trade-off between potential exposure to a repricing of more Fed rate cuts and the limited yield pickup in longer maturities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.